Hello, Matthew Blazewitz here once again for the demonstration of the Wildcatter simulation. In this video, I am going to cover how to create a production project from an oil strike. In the last video, we created this development project, an exploratory well that led to an oil find. And you can see here that the rig is now has a gusher coming out of the top of it. It is kind of blurry because of the other text that is for the project names. It is kind of crowded right there due to the amount of operations we have going on. But you can see pretty clearly that this is an indication of our oil find. So the next move is to prepare the well for production and produce from the well. To do that, we right-click on the project, select New Project, select Production, and this project will complete the well. It will go through all those procedures to complete the well and begin producing in it. For this project, one of the differences between the other project windows with the new production project is setting the rate of production. That can be varied throughout the simulation. A firm may want to turn down production during times when oil prices are less favorable, and turn up production when oil prices are more favorable from profits. Okay, so here, once again on the right hand side, we can see the projected cash flows. And an important thing to consider for the production project as far as accounting is concerned is that the simulation does not currently support leasing production projects. That is due to the fact the simulation doesn't support a capital lease, because all production projects for this simulation, the cost of the asset is capitalized into proven reserves, and the simulation accounting system uses a combination of the full cost accounting method for the extraction industry, and as well as the successful efforts accounting method. For the most part, the entire simulation, all costs are expensed immediately. The only exceptions are in exploration and development. There is a depreciation. Assets are capitalized and depreciated. And then for the production project, they are capitalized into a different account, which is the proven reserves account, and depreciated under a expense called depreciation, depreciation, and amortization of proven reserves. So right here we can see that the asset purchase is going to be $3,250,000, and that will be capitalized. And the estimation of it'll be capitalized, and then that total will be divided by the total amount of barrels that is estimated that will be produced, and then for every turn where a barrel is produced, that number will make up the depletion, depreciation, amortization expense. So we are going to begin this project, and once again, the activation of this new production project deactivates the development project. So that rig asset that is there it's still there. We won't be able to see it because of the production marker, but it is still there and still accessible, and it's inactive now. So whenever we start another development project, we can use the old rig. But right now we are going to create this production project. And you can see there's now a nodding donkey pumping the oil from the well. Okay, so now when I end the turn, we will have revenues in our statement, or our income statement. And look at that, a tax holiday. Income tax rates dropped to 18%, and this is the first year we're producing revenues, so that's a nice coincidence. And we can see from the project managers that the production project had 6 NPT days, and it also gives the amount of barrels of oil produced and then the byproduct of natural gas that is produced. Oil deposits produce both oil and gas, and then natural gas deposits produce only gas. Okay, so here's our balance sheet now. We can see now that proven reserves, property, plant, and equipment, that is the capitalized account for the cost of the asset for our production asset. We've got the income statement now showing revenue of $6 million and over $6 million, and we have both the depreciation, depreciation, and amortization of proven reserves for the amount of oil that we produced from that project. We also have the other depreciation expenses, and those expenses are strictly related to the exploration assets. Okay, and then we have our statement of cash flows. Important thing to note about the production profile, or the production project, is it has a production profile. So initially it didn't produce that much, so the production ramps up, and initially the simulation is set up so that there is a profile of increased production in the beginning of the project, then a plateau, and then a decay at the end of the project. So it's unknown at this time what the profile looks like, but one can track the profile throughout its life and see that the revenues increasing and then decreasing as the project production tapers off. So we're going to end the turn. We're going to end the turn again. Look at the next quarter, and here's we're in the second quarter now, and we have the Q1 results for 1865. And revenue, as we can see now, is going up because that production profile is production's really starting to ramp up. Okay, now revenue's kind of stagnating, it looks like. Now it's at 21 million. And we can also see here weather. Weather is another factor in the simulation. Randomly generated weather occurs. This is a little storm front. And there are different types of weather. There's thunderstorms, there are sandstorms, and then there are hurricanes, which are just really big thunderstorms. And the hurricanes usually occur in the third quarter. For simulation purposes, that's hurricane season. And if they strike one of your projects, what happens is the cost of that damage goes into an extraordinary expense account, something that's non-recurring, and it's rare, but it does happen, so it is something that should be taken into account. The sandstorms only occur in the desert. I'm not sure if there's going to be any that have occurred for this turn. But we will just go through and take a look. Doesn't look like any sandstorms right now. Some other thunderstorms though. But weather is a factor. That's the point to take into consideration. Okay, that concludes this video. In the next video, I'm going to discuss how to raise capital. And now that we have a profitable firm, the market should be receptive for perhaps an IPO.